Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to talk about how to properly analyze refinance benefits. Lately, we've been going back to some basic stuff here this past few trainings, and I definitely like it. We'll keep it on some basic stuff here today, but must know stuff as well. Go ahead and drop a comment there in the chat as you tune in. Appreciate everybody that's tuning in nice and early. And it looks like we're live on all the different platforms, so we can go ahead and get it started here. I see some comments coming in. Go ahead and keep dropping comments there in the chat, and you can also drop any questions you have in the chat. Jose would be happy to answer them after his presentation, but we will go ahead and get into it. So, change the screen here. All right. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is our Loan Officer Training Series, where we do a different loan officer training topic. And tonight, again, we're doing some more basic stuff here, which is how to properly analyze some refinance benefits. So, Jose, let's go ahead and get into it.
Good evening, everybody. Thank you for joining us for tonight's training. Definitely, with all of the volatility that's going on in the market, we're going back to some of these basic concepts, but the most important concepts, right? Especially when you're trying to add value in this whole process. Usually, the largest financial transaction that your typical borrower will do in their life, and you have to be there to guide them as a loan consultant, right? We are not application takers at the Mortgage Calculator, so you definitely need to be able to explain properly the benefits to a borrower of their refinance. You know, what are their objectives? So I'm not going to get ahead of myself here, because we're going to cover all of these benefits in the presentation. So let's get first real basic here. Why refinance? What exactly is a refinance? Well, refinancing is the process of taking out a new loan on a property to either pay off an existing loan, which would be your rate and term refinance, or tap into the equity of a free and clear property, which would be a cash out refinance. A cash out refinance is also going to be when you have your property that you are paying off an existing loan and are borrowing above and beyond that amount, any amount above your existing loan payoff and your closing costs is the cash out portion. Now, there are rate and term refinances that let you go up to 2% or $5,000 without being considered a cash out as far as proceeds of the refinance. Now, what are the key reasons to refinance a real estate loan? Well, the first one, it would be lower the interest rate, right? That's one of the obvious ones. Reduce monthly payments. Access home equity. There we're talking about just you want money. You want to go to the casino. Hopefully not, right? Hopefully you just want to tap into the equity for some things that you may need. And consolidate debt. Usually that entails higher interest rate debt, less favorable loan term, right? You want to extend the term maybe on that debt that you're consolidating as well, lower your payments. So a lot of different reasons why you're consolidating debt. But most of these, except for the access home equity part, typically have to do with lowering the monthly outlay, bettering the financial position of the household, right? So when does refinancing make sense? That's the key, and that's why you have to be aware and sensitive of many different facets of the transaction. But the first and most important one has to do with the timing of the transaction, right? We need to get inside the head of the borrower and find out what their specific financial goals are, what are their circumstances, because refinancing makes sense when it aligns with the borrower's specific financial goals and circumstances. That's one of the things to consider. It's not because you need to get paid as a loan officer, you want to get your commissions and all that. It has to do with what the borrower needs. Now, what are some of the scenarios under which refinancing may make sense? And some of these you may see some similarities to what I mentioned in the first slide, right? First slide, we're talking about uh, lower interest rate, reduce monthly payment, access home equity, consolidate debt. And over here, now some of the scenarios now when it may make sense to refinance is interest rates have dropped. But now remember, you as the loan officer are going to have to provide that cost benefit analysis in the end to the borrower. But interest rates have dropped is definitely a signal that it may be a good time to refinance. Improved credit scores of the borrower. They didn't refinance before, their score wasn't high enough for them to be able to get what they really wanted to get. Change in financial situation, right? Either they may need money, kids may be going to the university, somebody may be being hospitalized, they may have lost a job. A lot of different changes in financial situations that could make it the right moment to refinance. Reducing loan term, right? Going from a 30-year to a 20-year or to a 15-year. That usually tends to be a nice goal, especially with borrowers that may be a little bit more mature, looking to hopefully get that house paid off. They're already beyond the access home equity part of their life. Now we want to reduce the loan term because maybe by the time I get ready to retire, I don't want to have to pay principal and interest. Still going to have to pay taxes on the property, reduce taxes hopefully with some discounts. Still may have to pay insurance unless you decide to go self-insured, but you definitely want to save that principal and interest. And interest rates on consumer credit has risen. That's another scenario. That's a recent scenario right now where you may have a scenario, for example, where why would somebody want to refinance at a 7% interest rate? Right. Let's start with some of these different points. Well, what if their consumer debt is now at 32%, 34, 36%? Right. All you need to do is miss one payment or be 1 times 30 on a credit card, and all the other credit cards know that you defaulted on a payment, even though you're making the payment. That's how they look at it. Now all of a sudden interest rates rise on all the credit cards because written deep down in there in the terms of those credit cards is something to that effect. If you start if they see that your credit is not as good as it was before, and obviously being late on a payment on another card, they're going to see that could cause the interest rate on the card to rise to the default rate, maximum allowable by law, and that's really high rate. So obviously 7% is a lot lower than 30%. So there's definitely going to be a cost benefit analysis in this scenario. If the customer was using their credit card because they didn't want to do this cash out thing, they thought they could deal with it, but now they realize, credit cards are getting a little bit hairy there. Let me do the refinance and let's get that 7% rate, because now you're also going to be able to deduct the interest rate on that mortgage interest that you can't deduct on the credit card. So you're looking at that. You're looking at reducing your loan term. The loan amortization also is going to be better. If you need money, you need money, right? Change in financial condition. So a lot of reasons, but number 5 there is one of the ones that definitely hitting home in this current environment. So don't think you're not adding value to a borrower that's looking to refinance, because they may have a 5% rate or they may have a 3% rate, and but you may be helping them out. Maybe they can't get that second mortgage, HELOAN or HELOC, because they may not have enough equity or credit score or whatever it may be, right? Because the HELOCs and HELOANs do have a higher minimums, for example, than an FHA or a conventional loan or a VA or USDA or even a lot of non-QM options. So again, you really have to look deep, find out what their specific financial goals and circumstances are, because it's not just about the rate. The more you find out, the more you can be a consultant, the more you can add value, give good advice, and hopefully seal the deal, because you will have empowered your borrower to make that educated decision. This is not about being an application taker, production line kind of attitude with the borrower. This is about consulting them and explaining the scenarios to them. And that's where we're talking about now, analyzing the benefits, right? If we got lower interest rates, then yes, we have reduced monthly payments, if that's one of their objectives. More favorable loan amortization, which is and a lot of long-term savings. What do I mean by more favorable loan amortization? Well, if you look at an amortization table and you set up two interest rates, right, and you set up the amortization table, one at, let's say, 5% or 360. Or let's talk rates for now. One is at 7%, the other is at 5%, or let's say one at 8.6, whatever it is. You're going to see that the one at the lower interest rate is going to be paying more principal and less interest. So it's not just about analyzing the total payment. You could have one paying 700 and the other one paying $750. That's only a $50 difference. But what are you amortizing? That's the extra dimension that you're adding here to the analysis. What are you amortizing? Oh, all right, Mr. Borrower, at the higher interest rate, you're paying $150 principal. At the lower interest rate, you're paying $220 principal. So there's a $70 benefit more to each payment to amortize the debt than there is at the higher rate, even though the payment may only be, let's say, $50 lower, as an example. The overall benefit is the $50 plus the better amortization that you're starting with. And then with each payment at the lower interest rate, with each payment, there's a change in principal paid goes up a little and interest paid goes down a little. Well, if the interest rate is lower, the principal amount goes up higher, right? More per payment than it does at the lower at the higher interest rate. Excuse me. So the benefit is incrementally faster at the lower interest rate because of the better amortization. So the amortization is very powerful tool if you know how to look at it and explain it properly to the borrower. And then definitely that's when they're going to the shorter terms as well. When you're going to the shorter interest loan terms from 30 years to 20 or 15, then also the breakdown of the amortization is different. The 15-year typically is going to start almost 50-50 on the principal and amortization within the overall payment. Obviously, it's a higher payment because there's less payments of the principal. You're looking at, for example, 180 payments versus 360 payments. So logically, the principal payment is going to be higher, but then the breakdown is also much more favorable to the buyer. So that's really where you get the big time savings. Debt consolidation, obviously, when they're combining the higher interest rate debts like credit cards into one lower interest rate loan, you're going to have a lower payment just because of that. And on top of that, remember, you're looking at tax deductible interest as well on mortgage interest, whether it's a first mortgage, a second, or a third mortgage. Any interest that's paid on your dwelling, on a real estate, is tax deductible. Not actually just on your dwelling. This is on other real estate as well. And we talked about the shorter loan term, and then we're talking about home equity access, which is great. Now, one of the best things about accessing your home equity, let's say through a HELOC, is really what I'm talking about here, is pay interest only on what you owe. But also, you're looking at accessing that home equity for renovation of the property, any property or the subject property, investment, right? Buying other properties or another investment opportunity that may have come up, or the old family emergency, right? Somebody got hospitalized and now you got to come up with thousands of dollars in out of pocket rather than face hardship. So now you've explained you've analyzed the benefits. The customers have told you, okay, Jose, I'm ready to go. I love the fact that I'm going to be reducing my payments. I'm going to be reducing my interest expense. I'm going to be amortizing more on my monthly amount towards the principal. So I'm going to pay, I'm going to be building equity faster. So if I decide to sell the house in 5 or 6 or 7 years, I'm going to have a lot more money, a lot more equity built up because of my amortization. Thank you, Jose. But it's not over at that point. Now you got to make sure that this refinance goes all the way through to fruition, to closing, because if anything should happen throughout the refinance process, unless it's a dire emergency for the customer that they really need the money, it's real easy for them to say, you know what, Jose, things change now. It's not, I'm not benefiting as much from this as I thought as I was. Lost my motivation for it. Please cancel the transaction. So you don't want that to happen. So guiding the borrowers through the decision of refinancing, right, to make sure they're all in and everything is set up is so important. So the communication with the borrower is key. As always, as loan consultants at the Mortgage Calculator, we want to have open, honest, clear communication, transparency also, right? I've been talking about assessing their needs. Why are they doing the refinance? Make sure you understand that fully. You've analyzed all their options, presented multiple solutions, uh, because you don't want to have missed out and left money on the table because you didn't present one of the solutions that somebody else did. And then you may lose that deal that way. You want to highlight the costs of the transaction, the fees, the potential savings, talking again about amortization. And you want to evaluate, really important here, to evaluate the risks. What are the potential downsides, such as prepayment penalties? Make sure you explain those well, because those are actually benefits. If it's an investment property and they want a lower rate, lower payment, so understand how prepayment penalties work, be able to explain to them how much they would have to pay if the prepayment penalty was executed due to some reason, so they understand what they're getting into. Explain everything about the longer and shorter loan terms, and definitely talk about adjustable rate mortgages and the risks inherent with adjustable rate mortgages, like negative amortization. Most people forget that an adjustable rate mortgage has a payment cap, right? That payment cap means that's the payment limit. That doesn't mean it's the payment due limit. That's just, okay, they can only raise your payment X amount per year. But if the interest rate went higher, the amount that you're not paying is added as negative amortization to the loan. And besides, the indexes, the margins are high, and the indexes on the short term right now are a lot higher than on the long term. We have an inverted yield curve right now, so your 2 year rate is higher than your 10-year rate, for example. That's why we're talking about an inverted yield curve. So definitely guiding your borrowers through the decision, making sure the right product is selected. It's key to ensuring that the borrower stays in the process, because if it's not the right product selected, if they felt that they were forced into something that now they may get second thoughts, all it's going to happen in the end is they're going to cancel the deal, and you'll have wasted a lot of time, effort, and resources. So now definitely you want to prepare the borrower for the process, add value, right? You've already explained everything well. You're the consummate professional, but now you want to make sure you add value so that your borrower stays in the deal and closes. So make sure you explain thoroughly the required documents according to the guidelines of whatever program may have been chosen. If you're doing an agency loan, originating agency, that's going to be a lot simpler due to homogeneous guidelines, rather than if it's non-QM and you're talking about having to use AirDNA on a property that is a cash out refi. That's a very select product. So you want to be able to understand that to fully structure the deal properly. Definitely guide the borrowers through the application process, including, believe it or not, e-signing of the loan disclosures. I mean, it's not the first time somebody's had to have a Zoom meeting with a borrower to walk them through signing of the disclosures. You do not want to have a deal lost just because your borrower is tech challenged. Now, the all important credit check. Please make sure you discuss all, we've had the training on credit report review, fundamentals, looking for opportunities for credit simulation, improvements of credits. It won't be the first time that a loan is short 2 points and now all of a sudden you're having issues and the MLO never brought up credit simulations at the beginning of the process. And now all of a sudden they're hit with some weird conditions and they wish they had brought up the credit simulation opportunities, because had they done that, now they wouldn't be where they are looking to do a credit simulation and needing to close in 7 days, right? To bump up the borrower's credit a couple of points. So again, discuss this with the borrower before the credit is even pulled. You want to make sure that you ask the borrower about everything, or if the credit's already been pulled, you want to make sure you let them know. Don't open up any new accounts. Don't do anything like that. No new credit. Don't co-sign for anybody. Um, Explain the need for an appraisal and any obstacles that may present themselves, such as property condition and a reduced valuation. In other words, it's not the first time that an appraisal comes back and the house doesn't have, it's an FHA loan, cash out refi, and the house doesn't have kitchen cabinets and it's missing the toilets and the vanities and the showers are halfway done. And then we're like, we asked the MLO when we're reviewing the files, your manager, hey, weren't you aware that this should have been a renovation loan? I mean, it's okay. We got FHA 203K renovation loans, but this should not have been a regular FHA loan. And they're like, well, yeah, now when I asked the borrower about it, now that I know, they said that they thought they could use the money from the cash out to finish the repairs, right? Because they don't know. We're the licensees. We're the ones that have to explain all of these details to the borrowers, right? We're held one step above the borrowers because we have licenses, and that's why it is our job to be the loan consultant. So don't assume just because the borrower is not applying for a renovation loan that the house may not need a renovation loan. So you want to discuss these little factors, which may not be so little. All of a sudden, property condition keeps you from closing, and now you got to go back to the drawing board. And regarding reduced valuations, pull up some AVMs from somewhere. In a lot of areas, you can get an AVM pretty quickly. Some places even for free. And make sure you go over that with the borrower. Don't discourage them from doing the deal, because in the end, we're not an appraiser. It depending what type of transaction it is, depending how it's set up, there may not be a need for any secondary valuation method like an AVM or a CDA. So don't discourage the transaction, but just empower them and explain to them. And if they in turn want to reduce the loan amount a little bit or do what they got to do, that's okay. But again, you're going to be the consummate professional. And then discuss with the borrowers what happens after the application is submitted to ensure that no issues arise, right? What we're talking about again, don't open any new credit, don't spend all your money, don't accept gifts in cash and deposit them, don't make any large deposits, any of these things that could throw a wrench into your deal. But remember, though, at the mortgage calculator, we do have options for those non-QM loans that don't have seasoning or sourcing requirements on large deposits. So just let you know that we have solutions to all of those issues. So now you got the application is already in. You explain everything to them. Now you're getting close. You're getting close to a clear to close. Remember, on a refinance, they have 3 days. If it 3 days after the transaction closes, if it's a primary residence, 3 days after the transaction closes, to cancel the deal. Investment, not, but on the primary, yes. But even then, at any part of the transaction, even on the day of the closing, at the closing table, they can cancel on you. You don't want that to happen. So that's why we need to be transparent, right? Don't be afraid to share the information with the borrowers to empower them. That's the key here. results in a seamless transition, transitioning from process to closing with no interruptions, no hiccups, no people looking up at you and saying, "What's this?" Right? So again, first bullet point there: review and confirm the terms of the new loan that they're about to close on, and ensure that the borrower's objectives are met and that the borrower is comfortable with the terms of the new loan. It's what they expected, or if it's not what they thought they were getting in the beginning, everything was clearly explained throughout the process to them. They're totally empowered and understand. All they got to do is go to the closing and sign. That's what they're going to tell you. Okay, Jose, thank you. Uh, Explain to the borrowers how the funding is going to work. Discuss the timeline and the disbursement of the funds. Super important on the cash outs when they have a dire need, especially for the funds due to some time constraint. Explain to them how their current loan is going to be paid off, who pays it off, what's the process used to pay off, and the reason I say this is because they're going to appreciate more than anything than working with you, so that then they're going to understand how the loan closes. So they're going to understand nobody's going to steal their money, because it has happened that loans don't get paid off in the end. But obviously, that's not what we're looking at with the companies that we always use for closing. Another benefit of using professionals, and provide ongoing support and assistance through the closing and after the closing. Don't just disappear, because then you're not going to get any referrals. You want to delight the borrower with your service, exceed their expectations, and you will receive many referrals and have a sustainable MLO career. You guys know I always like to mention having a sustainable MLO career. You don't want to burn yourself out because you don't enjoy what you're doing, and you're going to enjoy what you're doing when you're helping all of these people reach their objectives, reach their goals, and making good money to boot. So that's a win-win-win situation for everybody involved. So I hope that you follow these pointers here. You can add value to your refinance transactions and have many closings every month.
All right. Thank you, Jose. I don't see any questions here. But again, great stuff. Back to the basics. I'll give it a second here, but it doesn't look like we have any questions. So we'll go ahead and wrap it up then. Remember, we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern. So I hope everybody has a great weekend, and we will see you next Tuesday, 7 p.m. for the next episode of the Loan Officer Training Series with the Mortgage Calculator.